George is a partner at the firm of Ross and Rosenthal, formerly been with Price Waterhouse, and has extensive experience in the fields of estate, gift, fiduciary, nonprofit, federal and state tax, as well as personal financial planning, forensic accounting, as well as having, he holds a degree from a Juris Doctor. He's a lawyer from Seton Hall University, a Master's of Law in Taxation from NYU. George is currently a member of the American Bar Association, the New York County Lawyers Association, American Institute of Certified Public Accountants, American Association of Attorney Certified Public Accountants, active member of the New Jersey Society of Certified Public Accountants, and he serves on the Estate and Gift Tax Committee, Federal and State Tax Committees, State Scholarship Committee, as well as the Corporate IRS and cooperation with the IRS tax committees. How do you have any time to come here and do this?
Actually, it's a funny thing. I teach also. I teach at Seton Hall Law School, and I teach at Bergen Community College. And the students say, when did I ever get out of school? Am I still in it? But it's great. It's fantastic. All right, being last, we're going to be talking about taxation, everyone's favorite topic. First thing that happened, number one, yesterday, is that government shutdown is finally temporarily out for at least 3 weeks. I mean, I have so many things I have to do with the IRS, which they've been on hold forever, so I don't think I'm going to get to them sometime this week, though. But what I want to do is I want to talk about tax reform. I'm going to be looking at it from a corporate standpoint first, and then I'm going to be looking at it to you from a flow-through, especially since a lot of the practices are S corporations. You know, the money doesn't get taxed at the corporate level, it gets taxed at the individual level. But because of the changes in the Tax Cuts and Jobs Act, what we normally used to see, C corporations, which are entities themselves, and you get taxed at the entity level and it gets distributed out to its shareholders as a dividend, it has become more in vogue. And the reason why I say that is because the corporate tax rate used to be 35% until last year. Now it's taxed at 21%. So you get taxed at the corporate level, then the money goes out to the individuals as a dividend. So dividends are taxed at 15 or 20%. So the point being said is the highest marginal rate for individuals is 37%. So you can see that it makes it advantageous to be a corporation again in this real world. The problem I always tell the clients, though, is you got to be careful. This is temporary. This was done with the Budget Reconciliation Act, so it expires after 2025. So you can see that you want to advise a client and say, hey, become a C corporation, then all of a sudden, in 5 years down the road, it changes. You got to tell them, really forewarn them, because you may be doing your client a temporary benefit, but a disservice going in the future. So just to give you an idea on that. One of the things for corporations, though, that's very important is it eliminated the alternative minimum tax. A lot of people don't know that. The AMT has been around since 1970, and that's the one for individuals and corporations that would get you. You know, you say you have your losses and all deductions, you end up with a small gain or an overall loss. But the AMT rears its ugly head and forces you to pay a minimum tax. And that minimum tax could be in the hundreds of thousands of dollars. So that's why you're going to be very careful with respect to it. Also, with respect to changes, and this is good for any business entity, flow-through entity, or a corporation, is it allows businesses to deduct the cost of depreciable assets that they buy. Starting in September of 2017, if you bought assets, you could immediately write it off as long as it was less than $2 million. So that's what really made it very good. The only problem with that, and again, just the technicality, was there was qualified leasehold property. Like companies buy, they buy property, they want to write it off really quickly. That was not incorporated into the new tax law. So that has to be depreciated over 39 and a half years. This was an uh-oh by Congress and not realizing that they thought everything was going to flow in, but they left out this one little provision. But for the most part, that's the good thing for companies. If you have it, equipment, you're buying equipment, medical equipment, that can be depreciated immediately. You can write it off. And it's different than having it on your books for 15 years. What does that do? It means you have a bigger loss. Your income gets, the depreciation gets deducted from your income, and you're paying less taxes. And that's the whole game for taxes. You want to pay as little as possible without putting on a yellow or orange jacket. One of the things that happens too, and I'll skip the first one because this one is a little more difficult and it's not really attributable to medical, but it's carried interest. And that's where individuals do work and they actually invest and they're expecting a return. Well, rather than being an ordinary income, that was treated at a special rate of 23.8. But again, if you're a corporation, 21% is still less than that as now. One of the biggest things that came out of this, and a lot of companies leverage themselves, they go out and borrow money in order to run their business, is they included, you're limited now to deduct only 30% of your interest. So say you go out and you borrow $10 million at 5%. What's 10 million at 5%? What would be our interest? No math people in here. 10 million at 5%, anyone? $500,000. So 500, excellent. So $500,000. If my practice makes $1 million, I cannot deduct that $500,000 now. I am limited to 30% of my income. So therefore, what would happen is it's taken away the losses that you potentially have. You're not going to lose it, but it carries over to the next tax season. So in this situation, I make $1 million in net income. I'm only allowed to deduct $300,000 of my expenses, and therefore I have a $700,000 income rather than $500,000 in income. What they're trying to do is prevent companies to ultimately leverage themselves completely and be able to take those huge deductions. We also have a lot of companies, probably not in the medical practices, that work globally. Okay, you have subsidiaries in a foreign country. And what normally used to happen is basically you would park that money in a foreign country and not repatriate it back to the US. Why? Because it was a tax deferral mechanism where you didn't have to take that money back and you didn't have to pay the tax until it was finally brought back to the US. Well, basically what's happening now is we are taxed on the foreign income that's earned now. And because there was a lot of money sent abroad, what happened was they gave a lower rate for you to bring back that income back into the US. At a one-time, say it was 7 to 10 to 15%, which was much better than the rates that you potentially have. So I just wanted to put that back in, and it allowed the companies really to repatriate $2.6 million, and they'd have a one-time tax rate of 15.5%. That's really good, right? If I can take money back and only to be taxed at 15.5%. Normally, a corporation would be taxed at 21 or the old 35, and if it flows through from a foreign, an entity like an S corp or a partnership, your marginal rate is 37%, the highest you can have. This could be a big savings, and a lot of people took advantage of this because the reason they didn't do it is because if I'm not being taxed on it, I can leave it overseas, let it earn money over there. But basically, what it did help the economy, and it put in 2.6 trillion money that came back, and at 15.5%, it's a pretty good deal. One thing that's very important, especially for businesses, is that for the purposes of federal tax law, you used to be able to take 50% of your meals and entertainment. So if you took out a client, you wanted to talk about business, you took a client out, you took them to a nice dinner, and then you went to a ball game, say. Well, guess what? What they did is they took a 50% haircut. So if it cost you $300, $350, they would give you $175. Now they even made it harder because what happens is you're only allowed to deduct 50% of meals. And what do you get for entertainment? 0. That really stinks, right? So now you just take them out to dinner and walk away, right? You don't want to go to entertainment. But for New York State purposes and New Jersey State, they have decoupled from the federal. So you can take the entertainment 50% portion for state purposes, but you can't take it for federal purposes. Okay, federal is where you really want it. State tax is between 6 and 8. Federal tax is at 37, top line now. So we'll get to that. So what happened was, what happens is when they had this cut, what they did is they took the highest marginal rate that you could pay as an individual, and not talking about the Medicare because that's a 3.8 surtax. The highest was 39.6%. They moved the tax rates down to 37%. So you have a 2.9% savings. And the tax foundation showed that really basically what happens is, those in the upper ranges will save significant amount of money, 2.2% more in their pocket. Those in the 20-80% will see 1.7. And then someone said, well, how about the ones that are in the lower 30-40%? Most of them don't pay tax anyway, so they're not going to get a benefit on it. The tax rates at that level are very low. So just to give you an idea on this, that even though it's a small rate percentage, that small rate percentage means more money in your pockets. This is something that is very important because in the medical field, unfortunately, medical accountants, attorneys, we are not subject to this if your income is above $315,000. What this did is this is what's called qualified business income. And what happened with this was, and again, I can tell you this is so top of the state of the art right now because I've been giving seminars for the last 2 weeks, and then they just passed the final regulations last Monday on this. So you can see that the questions now are, can we use the proposed regs or we do the final regs that just came out? The answer is you get to use which one you want for this year, but in 2019 you can't. What this does is it allows pass-through, if you have a Schedule C, your own sole proprietorship, partnerships, limited liability companies, if you perform non-specified service trade or business, and we call that SSTB. You're allowed to take your net income and deduct 20% and not pay tax on that 20%. So say, for instance, yeah, I am a practitioner, I'm a medical practitioner, but I have 4 or 5 properties that I own and I rent out. And that rental income that you get, say you end up getting $100,000 at the end of the day. That $100,000, because it's non-specified trade or business, it's not your business, it's rental where you're not doing it, you could take a 20% haircut and not pay taxes on it. So in the example, if I have $100,000 of rental income, I could take 20% off of that and not pay my tax on it. So if I'm in the highest marginal bracket at 37%, take 20% off the 37 and now you're paying 29.6%. So it's a great thing that happens, but the problem is everyone's trying to find out, how do you do this? And 2 practices that I've been working on, the medical practices, they're PCs, S-corps at the corporate level, and they also have a billing service. They have their own business, they own that. Well, the medical practice is not going to be a specified service, medical practice is a specified service trade or business, so you get no deduction. But all the billing in medical practices, what happens is the one company hires its own self to handle all the billing, health insurance, all that stuff that goes through there. That is a non-specified trade or business, and you can take 20% of that income. So it's a big savings if you can work around it. But the problem is the businesses have to be separated. You can't have an SSTB, specified service trade or business, and a non-SSTB and commingle it because then you'll get 0 deductions. And there is a safe harbor very quickly is that if you have a business and it only has 10%, less than 25 million in receipts, and if you have 10% or less of non-specified, they will disregard that and you'll be able to get that. And the question is, they want to actually bifurcate the business. Right. Keep the medical practice as one entity and keep all the auxiliary functions. Right. That's what we'll talk. That's specifically what we're talking about. But the problem is, if they got to be separate businesses, you got to have A PLLC, B, and you can. In my situation, it's both of them. Believe it or not, it's both having an S corp, and we create a partnership, an LLC, to handle the administrative stuff. Right. As long as they're separated. And again, the person's not being paid by both entities.
Why can't they be paid by both entities?
Because then there's a commingling of the businesses. What they will argue is you're doing this just to get the benefit of it. So what we did in that situation is we took the medical practice stays where it is, but the arm of the administrative handling the insurance claims, the collections, go into a separate entity.
Right, they go into a separate entity, but take like a physician who now wants to get better tax treatment on their own income.
Right.
So let's say they were making $700,000 a year as an overpaid dermatologist.
Right. Exactly. Good. Tell me what that dermatologist is.
Now what we're saying is take 300, which is fair comp, And for the services you provide as a business person to the services company, you'll get 400,000 income. And
Right.
you'll get-
And if you own it, if you own the company, the W-2 income from you is disallowed. So it doesn't make a difference because you got to take out the officer's compensation. Where the benefit is that you have all the employees in the other entity, their salaries are going to count for it. And then basically, if it's a non-specified service, trade, or business, we don't even worry about the W-2 wages. Because the problem is you automatically get the 20% irregardless of what your taxable income is. See, what happens, to give you an example, say a doctor's in a medical practice, just say it's 2 doctors. They pay themselves $800,000 in salary because it's an S corporation, so they can pay themselves. Remember, in a partnership, you can't pay yourself. If you're an owner, you can't be getting wages. Right. That's the trick there. But the point being said is, you're going to be able to take the net income from the business and take a 20% deduction on there. You're going to report the full income on the tax return, but on new Schedule 3, I think it is, you'll be able to take the deduction of 20%. So in my example, say we made $100,000. I just picked a simple example. $100,000, one owner. They're going to get the regular S-corp income that comes in from their medical practice. Now they're going to have $100,000 in income from the medical billing practice, and they will deduct $20,000 that will not be taxed. So they'll be taxed on $80,000 instead of the $100,000. But the problem is, with the medical practice, a lot of people are saying, well, look, they specifically excluded us. And that's why they're saying, no, it's not worth it. But it is worth it if you can find an arm. If you provide your own services, that's fine. Interestingly enough, so they really picked on us, accountants, attorneys, and doctors. In the regulations, they must have had a good PR group, but architects and engineers are accepted. They're not responsible. They get the 20% no matter what. They took those 2 practices and took them out and said they're not specified service, trade, or businesses. So maybe the doctors, we didn't have enough clout, so to say, yeah. And that's kind of scary because you think what they say with specified service, trade, or business is when you use your experience, your skills, and expertise to do work. That even accounts for wealth financial advisors. You know, Sheikh was here and I said, you're out of it too, you know, because you're providing your expertise to your clients. And that's the problem. And now all these, actually NFL and Major League Baseball tried to get out of it too, saying, well, no, we should not be in there. We're not, but they're providing their services, their specialty. And the IRS said, no, it's got to stay in there. So, pretty interesting though. But again, all the regulations for I literally came out, 1,087 pages came out 3 weeks ago, and we had another 257 pages of final regs that came out the other day. So we're all trying to get our hands on this, but everyone's like, how can we do this? Just know the general rule is if you're providing skills and expertise that no one else has, and that's your specialty, it's probably going to be a trade or business, and you're going to be excluded from that. Now, not fully excluded, just know that if your income is less than $315,000, then you don't have to worry about it, regardless what business is. But I mean, in the medical field, most people are, you know, using their expertise, and especially in this area, $315,000 doesn't go too far. And there is a small little catch to let you know, and I don't know if it's up here yet. $315 for joint, $157, but there is a $50,000 part where the $157 goes to $2,075, and the $315 goes to $415. If you fall into that realm, then you have what's called a phase out. So you may be able to get some benefit, but you won't get it all. But it's calculations that you have to do. And I thought this Tax Act was supposed to make things simple. What happened to the postcard? You know, that's what they said. It's not a postcard anymore. Believe me, it's much harder. Again, the general individuals that, you know, that on the lower end are not, it's going to be easy for them, you know, and that's going to be much better. But the problem is it makes more complication for those that are in specialty fields that they, you know, expertise especially. So,
income you mean what's declared on your W-2?
yeah, the income that you, the net income that you actually it's the adjusted gross income that you have on your tax return. Okay. If you look at page 1 of a return, yeah, it's before deductions, it's the adjusted gross income on the bottom line.
So as long as you keep your 1040 less than 157,
if individual 157.5, right, or 315, okay, then you have no regard. You get 20% off of everything you do.
Even if you're a physician, lawyer.
That's correct. So, And maybe this would be great in Kansas, Kentucky. You know, I'm just trying to say areas that don't have the high cost of living like we do. You know, everyone says that's not fair, but the problem is the tax code has to be equitable to everyone. It doesn't look at, well, I'm living in Alabama, or you know, I'm not picking on areas, but you know, the cost of living in Alabama is severely different than the cost in the metropolitan area. But they can't treat people differently, and that's why. Any other questions before we move on? Just to let you know, I just want to look at it from an individual standpoint. Literally, when I just did it for the New York Bar Association, and I did it for the Bergen County Bar. I gave a seminar on this, and it looked like my students in my tax class. They just looked like deer in headlights. It's not easy stuff. And the problem is, what scares me is I just gave it to also the CPAs. I gave it to 300 CPAs, and I had a line out the door because they didn't understand it. And I tell them the more I know, the less I know, but apparently I'm supposed to be an expert. And I'm far from an expert because it keeps changing. You know, and that's the problem that you have to stay on top of. And I seriously think that you go to your CPA, you're going to have a lot of issues, and your return has a good chance of being, you know, not perfect when it goes in. But again, the IRS is going to have a very difficult time auditing this as well, you know, because there's no rules or regulations on what they have to do yet. So I know you can't see this, it's small, but you can see that if you're married filing jointly, now what happens is, before, if you made, say, $480,000, you were in the top bracket at 39.6. If you make the same money here, you're down at the 35. So 39.6 to 35 is 4.6 deduction, which is pretty good. But you can see that they brought the rates down from 10, 12, 22, 24, 32, 35, 37. Each of us are entitled to each one. So your first dollar of income all the way to $19,000 is going to be taxed at 10%. Then your next amount above 19 up to 77 gets taxed at 12%. So these are the marginal rates, but the effective rate allows us to go through each of the brackets. So you may end up at $400,000 and being taxed at 35%, but your effective tax rate will be something like 25%, 24%, because you're able to get the benefit of the lower brackets. It's just not because you're at the 400, oh, I got taxed, everything is taxed at 35. No, it's a graduated rate that we receive. So we get to have the benefit of 10, 12, 22, 24. And if you notice, you can see the difference is that it was started at 25 at 77, now it's at 22. So everyone technically benefits unless you're under 19,050, because it's still at 10%. This is the Tax Cuts and Jobs Act. This was, say you were living in 2017. Okay. This was the law. This is 2018. Yeah. And now 2019 will still work off this, yeah, but you get the consumer price index jump. So what happens is the rates will go up, you know, 2 or 3% each, you know, whatever it comes out to. Say we're at 3% inflation, this will be expanded by 3,000. So it will make it. It has always been that way. So the code, the brackets have always changed. When someone says to me, well, I got 77, where are you? I said, don't know. We got to find out where you are. But I can assume that if you're at 77, you're going to be at the 22% rate. That's what you want to look at. Okay, any questions on this? Now they also took away, remember the personal exemptions? If you were married, you had kids? The IRS doesn't care about your kids anymore. No, I don't want to say that. They just don't give you a personal dependency for it. So what happens is on the standard deduction, it changed for single from $12,000 to, and if you're married filing separately or head of household, it's going to be $24,000, and on a joint $18,000 on a joint return, it's $24,000. So why did they do this? Well, no more personal dependencies, but they also took away the state tax deduction, right? Because remember, how much are we allowed to take in our personal income taxes and state taxes that we pay? Anyone know? Except my other attorneys here. How much are we allowed to take? You know, if I had property taxes, say I had property taxes, I live in Bergen County, New Jersey, right across the bridge, I pay $18,000, $19,000 on property taxes. But I also pay like $40,000, $50,000 in state taxes. I'm limited to $10,000 deduction on my return. So that was the trade for the lower rates. I'm going to lose some of my itemized deductions, but I'm going to have a lower tax rate. And you'd be surprised that someone said, oh, I'm losing $70,000. I'm at $850,000. I'm losing $77,000 deduction. I said, well, guess what? You're also saving about 4% on the $800,000. So a $40,000 saving, say $35,000 saving, versus a loss of that It's not a big deal. I mean, it's still, they're surprised that they end up more favorable. But not everyone's happy about that, because those deductions you like to have. Child tax credit used to be limited based upon your income. Okay, now what happens, the credit begins only to phase out at $400,000. It used to phase out at $110,000. So say if you were a mid-person, you make $315,000, you got no child tax credit. But now, because of the increase, it's a $1,000 tax credit for each child under the age of 17. If your child turns 18 anytime there's in 2019, you get nothing. They got to be 18 at the end of the tax year. Same thing with your filing status. You know, you've been married all year, but you get divorced on December 30th, guess what? You're deemed to be single for the whole year. That's the problem. Or head of household if you have children, if someone's taking care of them. So just wanted to give you that. Also, mortgage interest. This is another big change on here. The good thing about the mortgage interest is that it's grandfathered. So if you have a mortgage that you have $900,000 mortgage, say, and you take the deduction, mortgage interest is fully deductible. There's not a limit on it, but they limited the amount you can use. So the $900,000, I can still take my mortgage interest. But if I went out and said, got rid of it and got a new loan, and it was $850,000 loan, guess what? It's now limited to $750,000. So I will lose part of the exclusion. They grandfathered that because people that took out loans would really technically be damaged or harmed by this, because it would be unfair to them. But a lot of things that happen no matter what, it's the $1 million mortgage. You know, some people may have a $2.1 million mortgage. Well, guess what? They're limited to $1 million over the average. What happens is you take the average amount of loan during a year. It may start off at $1 million, and it goes down to $900. It may be $950. But that's what you start with, or with respect to it. So it does get phased out. Again, same thing is they still kept in there, which was great, if you own a home and you happen to sell it. If you're single, you're allowed to defer, you're allowed to eliminate $250,000 of your gain. And if you're married and you lived in the house for 2 of the past 5 years, it's $500,000. I have some clients that want to move out of this area, they're moving to Florida. They're keeping their house up here because I like to see the kids, the grandkids and stuff, but they want to get out of this tax mess, a fiasco up here. So they moved to Florida. 2 years later, he decided, you know what, I don't need the house up there anymore. I'll just stay with the kids when I come. I want to sell my house. And he has a gain of $400,000, and they're married. Does he get to take that advantage of the $500,000? Right. The rule under the code, section 121, says that you're, as long as you lived in the house for 2 of the past 5 years. So I said, guess what? Sell it now before December 31st. Otherwise, this is year 6, and guess what? You're out of the thing. You're only living there for 1. So that's a good point about that. Question? Oh, I did you? Okay, that's fine. So basically what happens is, you know, 2, I don't know why I put 24 to 60, but that's what the code says. It's 2 out of the last 5 years on there. There we go with the property taxes. We talked about it. New Jersey, New York, Connecticut all tried to get this finagle way to get out of this. The point is that they think it's unfair for high, you know, metropolitan areas that have high cost of living, because we know the taxes here are higher than, except for California and Illinois, the Northeast is probably the worst. But you're limited to $10,000, as I said. A lot of people tried to do a workaround. So what they did in New Jersey is they allowed you to prepay your first 2 quarters of 2018 last year for federal purposes, but you couldn't do it for state purposes. Connecticut is now doing a tax. I have a few attorneys that I handle at firms in both New York and New Jersey. They're both here, but they tried to work away with Connecticut where you can take 93.07% and be able to use it as a contribution, and that's still being challenged. But you know, any way you can find a way out of something, someone will. But you know, this is really what's hurting this area right here, is the lack of taking the deduction for your, and that's not only property taxes, it's the state taxes that you pay as well. So it's limited to $10,000. Interestingly enough, though, and this is what I try to do with individuals too, if they have a business, you know, even you lost all the personal itemized deductions too. Your tax prep fees, your counsel advice for estate planning, all that stuff is off the table because they eliminated the personal exemptions. So you no longer have personal exemptions as well, But if you have a business that someone's doing your work for you, you may be able to put it on a Schedule E or a Schedule C. Schedule C is when you're a proprietor and you're owning your own business, hang up your own shingle. Could be an LLC, but sometimes it's just a sole proprietorship. And also Schedule E is your rental property. So if you're doing work for stuff, you may advise an attorney, you may have a CPA. That stuff can flow over to the Schedule E, not all of it, but you got to allocate it. But that's a way that you can bypass some of the losses that you have on that. Because they're doing work for your entire self, it includes all your other stuff as well. So, someone has to draft up a sales contract on the rental property. Well, guess what? You put it as a miscellaneous itemized deduction, it's non-deductible, but now you can still take it on Schedule E. So there are workarounds on some issues. Believe me, they've been going crazy for the last 6 months trying to find it. This is what I was talking about. Unreimbursed employer expenses are no longer deductible. That would go on to miscellaneous itemized deductions. Also, medical expenses. Just for 2018, remember a few years ago, they took your medical expenses and you could only deduct it if it exceeded 10% of your adjusted gross income. Most people say if you're making $600,000, you need $70,000, $60,000 to take it. Well, only for 2018, they brought that down to 7.5%, where it originally was 5 or 6 years ago. The only difference was the medical expenses for anyone under 65 was 10%, but if you were 65 or older, it was 7.5%. Why? Because congressmen need your vote. And they don't want to hurt the elderly that are owning, so that's what you have to look at. And again, also the ACA, those that did not have insurance, it's still in effect for 2018, the penalties that the IRS can assess. But starting in 2019, there will be no penalties on the Affordable Care Act if you don't cover yourself with medical insurance. And this happens, what happens is you basically leave a job, you're not going to take COBRA, you go to a new job, there may be a requirement of a 90-day wait. Well, guess what? During that time, you are obligated to cover yourself for insurance. You could have took the COBRA, but the point by you leaving is that you're leaving yourself open. You would have to go out to the market to get the Affordable Care Act. And a lot of people didn't do that, and then you get a penalty. Yes?
With the medical expense, does that mean before insurance covers?
Yeah, if you, on your return, if it's pre-tax for federal, you're saving it, and that's what they normally do, that does not count. If you have to pay for it yourself out of pocket, that all counts. Where do you see a lot of this, even with high net worth individuals? Maybe they're getting up in age, maybe they're going to a rehabilitation center, maybe they're in assisted living. Those are the ones that have the big ticket items because you can still deduct that. Regular, kids, you take them to the doctor a few times, you get a cold, get medicine. That's not going to hit that for most individuals. It's really where someone is having a situation where they're getting assisted living and stuff that wouldn't be there. And again, just because they're in assisted living doesn't mean they still have a domicile. Your domicile is originally where you are. You don't move to the assisted living even though you're technically there. So you can take it as a deduction. Big change, alimony. I don't know if you guys know this. What normally happened with alimony is that it was deductible for the person that paid it, but it was included in income from those that received it. So that's, and again, not child support. Child support's a different thing. You make it, you pay for it. That's what the code says. But the point being said is, it's your problem regardless. But here, what they're saying with alimony is before you could take the person that paid it took the deduction. The person that received it had to count it as income. And what happens is if you received it as income, you probably didn't pay payroll tax, you didn't pay taxes on it or estimated payments. But now, starting in 2019, alimony is neither deductible or includable in income anymore. So at the end of the year, I had a firm right down the road from me. We're talking. He's like, we have people that have been waiting for like 6 months just to get divorced. They'll live together just to 2019, and then you get out. Because really, in essence, it's more fairer. But again, I'm sure the courts are going to fix the alimony amount because that's what's.
This is terrible. This is the worst thing I've heard all day.
What? Sorry, I didn't plan it. Well, no. If you were the payer and you wanted to get divorced, you should have done it before December 31st.
I'm in the clear right now.
Yeah. Yeah, it's crazy. Well, listen, in New Jersey, it was funny because they finally had alimony reform, because in New Jersey, you could have been married for 2 or 3 years, and then the person that left could cohabit with someone else. And one of the guys that I had to pay for 25 years of alimony. Yeah, and she was supported. She was just smart. She didn't decide to get married. She got remarried. Guess what happens? The nice gravy train is gone.
That was some bad legal work, I guess.
No, that was the law in New Jersey, but now they base it upon how long you've been married. So if it's a certain level, it could be only 5 years, it could be 10 years, it depends. The longer you're married, the longer you're going to end up paying, so.
You know what, I've liked you up until that.
Yeah, I know, it's kind, hey,
So far.
I was going to look at the attorneys, but they don't do alimony, but they know that that's a messy situation there.
That's why I like him too.
One thing too also, and this is what a lot of people like to do, is Roth conversions. Got to be a little bit more careful before you're able to do conversions, because I recommend to clients now that, hey, why take the benefit? You're not really getting the benefit putting it into a regular IRA. You know, don't worry about the pre-tax. Put it into a Roth IRA and let it grow. As long as you hold a Roth IRA for 5 years, the distributions that you take out are non-taxable. So that's the most important about it. Remember, on a regular IRA, you take out money before you're age 59 and a half, you get slapped with a 10% penalty. There are a few exceptions, you know, but for the most part, you would get slapped with a 10% penalty. And that's not fun. And then someone has to say, well, gee, I took out 100, but I paid 20,000 in tax. Why am I still getting whacked? Well, they had a 10% penalty, which meant another $10,000 on it. But basically what happens is you can no longer do a do-over, because some people would put it in. I'd recommend, say, well, you shouldn't have done that. You're not getting any benefit from it. You're in the same bracket. So you might as well just do a do-over, put it into a Roth IRA as opposed to a regular IRA. No longer. They're just shutting down that thing there. Stock sales, okay? Basically what happens is now you know, and this is with the last few years, with stock sales, your broker has to come up with a method of where you're selling your stock. If you don't work with them, the default is first in, first out. Why does that stink? Because if you bought stock, say you didn't take any distributions, you bought stock in 1990, and you're selling it in 2018, I'd rather sell the 2018, right? Because there's less of a gain. They're making you go back to the first in, first out. But you would have to make the election with your broker. But the first in, first out rule is the problem that you run into there. So again, naturally what happens is I made sure my client did an average weighted, because she owned, I think it was 37,000 shares of Pepsi, and her cost basis was $4, and you know where Pepsi is now. It's a huge gain. I don't know why she picked that. She picks a few stocks, but they've all been like diamonds in the rough, so it's crazy. But then she naturally they get mad. How can you change this? Well, we went to the average cost rule, so no matter what, you're going to pick up gain, but not the big gain that you would from years earlier. You move. Guess what? It's on your dime now. No more moving expenses. The old rule used to be if you moved for a job and your job was, if your house was 50 miles or less more from where your new job is, you would be able to take moving expenses. And the problem is they're no longer there. For the most part, I think most companies have grown it. If they want you to move to a location, they pay the relocation expenses. But if they don't, you're able to take this as a direct deduction for adjusted gross income. Like I mentioned, the ACA penalty will be gone. And also those that have children, if you have a 529 plan, it used to only be able to be used for higher education. Now you can use it for secondary education from grade 9 through grade 12. So it allows parents, if they wanted to send their kids to private school, they could use the 529 plan to do so. Okay? Only difference is you only get a $10,000 benefit for 18, but they're talking about 19 being unlimited on that. So we'll talk about that.
Sorry, real quick on that slide, K
Yep.
through 12 or 9 through 12?
No, 9 through 12. They call it elementary education and secondary education. So it's high school.
Got it.
Okay. I don't know why they take all these things. I would say, why couldn't you do it for everything, especially with the cost of education? And again, this is just showing you very quickly, and this, I don't know, did they get these? Did you get this PowerPoint presentation? Oh, you, what's it? Oh, you did, okay. Please take a look at this, because this is the rule that happens. The new law / the rate on corporations, we talked about that. But we also really touched in very limited on the pass-through entities. And the pass-through entities normally are going to be taxed at 37%, the maximum, or whatever rate you're in. If I'm lower, it's not going to be at 37%. But that's where it talks about the 20% of income taxation would reduce it to the 29.6. So I just want you to see what would go on there. But that's a good point. And I think what's going to happen is you're going to see a lot of planning in 19 for those that didn't do it in 18. Or maybe a good savings if you're able to do something to break out an entity. You know, things that you do that are administrative, you may give out an arm. So what you can do is have the one company pay a management fee to the company, you know, to do all that work. And that's where you get the loss, because that's non-specified trade or business. Kiddie tax. If your child, many people didn't realize this, but the kiddie tax is if your child had unearned income that was greater than 2,100. Last year it was 1,950. But if it was greater than that, they would have to pay tax at the parent's rate. So either you could put it on your return and get taxed, or the kids would have to file their own return and get taxed. Now the rule says you can't piggyback on your mom and dad anymore. Every child that has greater than 2,100 in unearned income must file their own return. And they get taxed at a trust rate, which is very high. If they have over $12,500 in unearned income, not talking about money they earn if they go out and do it, and it's up to age 24, unless they're physically able to depend, you know, they're not a dependent of their parents and they take care of themselves. They're going to get taxed at 37%. That's insane. So that's why they're really going after this, because people abuse money by trying to transfer money to their kids, and they get taxed at a soft rate. It used to be only to age 19. And then about 7 years ago, they changed it to anyone that's under age 24 that is a dependent. Now, dependent means that they provide more than 50% of all their support. So, oh, I can do that. I can do it. Yeah, but housing, right? Cars, vehicles, insurance, all mom and dads pay that, right? So guess what? They are getting support from their mom and dad. But this, to me, took me really odd on this. Now, again, this is on interest in short-term capital gains. But if they have dividends, just like qualified dividends and long-term capital gains, they're still going to be taxed at the 15 or 20% rate. But it's the regular, so what a lot of advisors are saying is, let's get out of interest. Either have tax-exempt interest or put it into qualified dividends, you know, in regular dividends. Because the interest is what's going to hurt you. And that's going to bring your rate up to 37%. So we talked about the mortgage interest. Home equity. You may deduct the home, again, this was a misnomer where people read the code wrong. You can still deduct home equity interest if the proceeds are used and plowed back into the home or a property or so forth. You have to invest the monies. And if you don't invest them, you would not get the deduction for the home equity interest. Charitable contributions. Still allowed to take the fair market value of what you give or the property that you provide to someone else. The only difference was you used to have a 50% cap of your adjusted gross income. So if my adjusted gross income was $300,000, I could only donate $150,000 deductible. If I had more, it's suspended, it was carried over to the next year. They moved up the rate to 60%. Not a big deal, it's just most people do that. And again, the 10% is down to 7.5%. If you're at a lower rate, it's going to help out those a lot better. They can still take medical deductions. But if you're in a high income tax bracket, unless you have an issue, you're not going to be able to take the deductions. Okay, and there we go, the SALT deduction, right? That was the most controversial aspect that we dealt with. It prohibits you from taking state and local taxes above $10,000. And we were hoping back in the middle of the year that they would change it. There was hope that was going to be done, but it did not change. So at least for 2018, and right now for 2019, it could change for 2019, you never know. Because now we have a House is controlled by both the Senate and one controlled by the Democrats. So the Senate's by the Republicans, the House is controlled by the Democrats. They may work this out because it is affecting individuals on here. Okay. So the pass-through, like we talked about, I leave this up here. I just want to make sure that you know that this is the big controversial issue. I just wish the IRS would have worked on this because a lot of practitioners, I can tell you, I would guess that your CPA has a 1 in 2 chance of knowing what's going on this. That's how bad it is. I'm on a listserv, and I get calls all day long on this. And I just want to know who made me an expert on this, because look, I followed it for the full year. I fully understand it, but there's a lot of nuances that are still out there. So just make sure, say, do you understand 199A? This, if they say, what are you talking about? Say, all right, sorry, not doing it, because you could lose out on that. Okay, another good thing that's happened, the AMT has always affected mid-earners. All right, so I always see it happening with clients that make between $300,000 and $900,000 or $800,000, because what happened is you were able to take all these deductions, and you would say, look, I don't have a tax, but there's a parallel tax called the AMT that would hike your rate up. And I always fell into the AMT, and that's what I hated. But now what they did is they changed now basically you don't have to take those, you don't get those itemized deductions anymore. So those are the things that add it back to the AMT. So most people will not be subject to the AMT. If you're under $1 million, the chances are you will not be subject to AMT. It used to be the AMT exemption was 54. Now it's 70,300. And if you're married, it's 109,400. So those technically are where you can take the deductions. And if you go over that amount, you're going to be subject to AMT. But the chances of you being in it used to be about 60%. Now it's going to be about 15, 20%. These are the deductions that you would take on a return that are no longer here. Casualty and theft losses, that really stinks. They've been eliminated unless it was declared a national disaster. So someone steals your car. You have a nice car, you're not fully covered by insurance, you have a $30,000 loss. You would be able to take that as a deduction on your return, no longer. So that's out there. Unreimbursed employee expenses, if you have expenses that you incur that your employee does not cover, no longer deductible. Tax preparation. As I said, I moved that more to Schedule C, Schedule E. Any other miscellaneous items. Most people didn't realize that if you had an attorney draft your plan and do an estate planning, that was deductible as a 2% itemized deduction, no longer. Moving expenses that we talk about, and also this is pretty key, especially in New York, subsidized parking and transportation reimbursement. Firms used to be able to subsidize that, do it pre-tax for you, and it would reduce the cost of using, mass transportation. That's no longer there. I know a family member that comes into New York got $210 from, she works for Fox News, and she was able to get that, and reduce it, take it pre-tax, so she's saving 30, 40% of that money, no longer. The most important thing, and this is what makes our job so tough, and because when I tell someone this and they love it, I got to remind them that it's only temporary. What happens 2 years from now if the Democrats take full control of both the House and Senate? I think they're going to eliminate this because it's no benefit for the mass that they're representing. So the point being said is, when I'm advising, I have to at least let them know that, yes, this is what we're doing now, and it's good for now. But I can't guarantee you 2 or 3 years from now it's going to be there. Regardless, I tell them that it's gone after 2025 unless they get it passed. There's a lot of uncertainty on this, and you want to make sure you get the right answer, and that's what's important.
Once again, on behalf of Neuro Alert and all the presenters, I want to thank you very much for your attendance today, whether it was live or online. And we look forward to hopefully seeing you again. Hope you had a good day and got a lot out of it today. I want to thank all the presenters for taking their valuable time today to come and work with us all. And I'd also like to give a shout out to Maria Sarcino, who did all the logistics here for us. So thank you, Maria. It's been wonderful. Thank you.